Market Insight webinar for quarter 2 of 2013. My name is Stephen Molinario, and I'm a portfolio administrator in Ironwood's investment division. Tonight, it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the CFA designation, and he also serves as Ironwood's primary investment strategist. And so, without further ado, please join me in welcoming Sean to lead the evening's presentation. Sean?
Thanks, Steve. Good evening, everyone, and welcome to our Market Insight call. I want to first thank everybody for joining us tonight. Thanks for taking the time. We're hoping to give you some insight on what exactly happened during the first quarter. We started with a bang, at least when we look at domestic equities. So we'll go over that a little bit later. But as most of you probably already know, the Dow and the S&P are both at all-time highs as of today. So that's a good thing. We've started off the year with a bang. We successfully climbed down the fiscal stepladder, is what I like to call it, and I'll explain that a little later. And the economy continues to improve, albeit at a slow pace. So those are some of the things we want to go over tonight. I'll leave it here on the disclosures page for a second. Kind of went over the topics that we're going to cover here in that first slide. So I wanted to start with this slide. This is a slide that we showed in a past Market Insight call. We actually showed this during our August 5th, 2009 Market Insight call. At the time, the S&P 500 was at just over 1,000. It was at 1,003 the day, August 5th, the day we showed this slide. The data here that this chart is showing was actually as of the quarter end, June 30th, 2009. We asked a question as we showed this slide to everybody that was on the call that day. Said, okay, the S&P is at 1,000 points right now. When will it reach 1565 again, the 2007 high? And we got a lot of answers that were in the 5-6 year time frame. We even got some answers in the 10-year. Well, it's been almost 4 years since the low of the market, which was March 9th, until we reached those highs. It was just over a year. It was a year and a couple of days, or I'm sorry, 4 years and a couple of days until we reached those highs. So if we look back here, that would have implied that we earned about 16.7% over that each year over the past 4 years. And that's pretty much what the S&P has given us, and then some, because now, most of those numbers were at quarter end, and the S&P has continued. Today we're just under 1,600 on the S&P. So wanted to bring that up because there was a lot of, during this time there were a lot of people who were concerned about the markets and would they ever get back and how long was it going to take. This just reiterates why we have time frames on equity investing. We want to make sure we have the correct time frame when we're investing in equities, because this next slide shows why. If we were to have invested on maybe what could have been said as the worst day to invest, probably in the past 30 years, October 9th, 2007, until the quarter end, so until March 31st, 2013. Now, if we would have invested, closed our eyes, held our breath, and not looked at our account statement until recently, we would have made 13.2%, most of which would have come from dividends over this time frame. Because you can see we're, from the old high to March 31st, we're relatively basically at the same point, but the entire time you were collecting about a 2% dividend. So that's one thing that folks forget about is, yeah, you're collecting that dividend. If you're reinvesting that dividend, you're buying, shares that are less expensive down here, and as we come back up, we can actually have a positive return. Now, not a lot of people could handle a ride like this, and especially if you're in the distribution phase of your retirement, a portfolio of 100% S&P 500 is not going to be a good, suitable portfolio for somebody who is in the distribution phase of retirement. If we have to take money out at these different levels, well, we're selling low and we bought high. We want to make sure that we have the correct time frame. So even with one of the worst market performances that we've seen in 100 years, 4 years later, we still made 13.2%. If you would have had all your money in cash over the same time frame, you would have made less than 13.2%. So we're just trying to reiterate that in the long run, stocks do tend to pay you more than cash. And we want to make sure that we can withstand very volatile periods. So we need to have part of your portfolio that isn't tied to very volatile areas. Kind of going on the same path here. Now, is it time to bunker in? You know, that's the question that we're getting asked a lot lately. When is the market going to pull back? You know, should we go more conservative? These are the questions that are coming up in our meetings with clients. And one of the reasons is the market's kind of trained us to think, okay, well, we go up 100%, we come down 50. We go up 100%, we come down 50. We go up 100%, what's next? Well, if we follow this chart, maybe a down 50. That's not what we think is going to happen. There are market dynamics that are much different now than at the 07 high and at the 2000 high. And those dynamics are right here in this page. We can look at the index level. The index level was exactly, well, not the exact, but very, very close for each of these different levels. However, what's different is where earnings of the S&P are and the relation of price to earnings ratio. So in 2000s, there was a lot of greed in the air, a lot of folks going to their neighbors and their best friends and saying, I made 100% in the stock market, what'd you do? And there was a lot of greed. So there was a lot of buying of stocks. We were at irrational levels above where earnings would really allow us to be. And so the multiplier, the PE ratio, was at 25.6. Just to give you a historical perspective, 25.6 is much higher than the average, which is somewhere between 16 and 17. Now, 2007, we weren't, we didn't get expensive on PE. We're getting close to the historic norm. What happened in 2007 is we had low interest rates for a long time. We had the real estate market go like gangbusters, and we had a credit crisis. A lot of people shouldn't have bought homes that bought homes. So we had to get through that mess. That was the Great Recession that we just went through. Now the stock market's back up, but profits are also back up, which means the PE still looks attractive. It's a little bit higher than this now because we're almost at 1,600 on the S&P, but let's call it 14. We're still below historic norms. And the other levels here, if you look at dividend yield, you're getting 2% from the S&P if you're just buying the S&P. And we look at, okay, well, what are our alternative investments? We can go to cash, which is maybe paying us 0.5%, or we can go to a 10-year Treasury, which is paying us 1.9%. Well, at the end of March it was. Now it's paying us 1.65% as of today, which isn't even keeping up with inflation. So you can lock your money in a 10-year Treasury and almost be certain that you're going to lose to inflation, or you can, have a diversified portfolio that includes some stocks in it, earn 2%, earn, a little bit higher risky bonds. So there's, stocks look very attractive on a relative to bond valuation basis. And we'll go a little bit further into that later in the presentation. So those are the slides that I just wanted to show to give us kind of a historical perspective and kind of see what we went through the past 5.5 years, from 2007 until now. You know, the market's back up to where it was, just slightly above. Man, it was a roller coaster ride, but the folks who really hung in there and stayed with their plan were the ones that ended up doing the best over those periods of time. So, you know, there's all this, I'm talking about, oh, the market's at a high, things are looking good. Well, things aren't all good. The economy is still in a recovery mode. It's not recovering like gangbusters. It's slow but steady. Domestic equities soared in the first quarter. The S&P was up just over 10%. Small caps were up over 12%. But contrary to popular belief, not all aggressive asset classes performed well in the first quarter. Emerging markets actually was negative for the quarter. A lot of folks didn't realize that. Commodities also were negative in the quarter. Bonds were also negative in the quarter. So even though domestic stocks did very well and the S&P 500 is at all-time highs, if we look at where emerging markets are and where international markets are, it's a different story. And I want to go deeper into that a little later in the presentation. ISM numbers came in strong during the quarter. All 3 months consistently came in fairly strong. The job market continues to improve. This morning we had the lowest jobless claims that we've seen since early 2007. Low 300s. It was 324,000, I believe, 24 or 29,000. The last 6 months, we've increased jobs by about 200,000 per month. You know, nothing to get really excited about. It's decent, but it's not stellar. So there's still some work to be done at creating jobs. Asset class performance, I already went over small caps. I already went over the S&P. REITs, real estate investment trusts, were up 8.1%. Developed international was up 5.3%. Market neutral, cash, they were pretty much flat. Bonds were negative, but pretty much flat. Commodities we talked about. Emerging markets we talked about. U.S. economy does continue to improve, has continued to improve. We had a little bit of a scare in the fourth quarter of last year. We believe that, first of all, the GDP grew at an anemic 0.4% in the fourth quarter. That's very low. It's our thought that it was almost as though the U.S. was holding its breath going into the fiscal cliff discussions. Q1 2013, the first estimate was for growth of 2.5%, and that's in the face of the payroll tax holiday expiring. So for the past 2 years, we've had the payroll tax holiday. It expired. That is a huge headwind on consumers for 2013. A lot of economists were worried about that going into the beginning of the year. And with all the fiscal cliff talk, you know, we didn't really know what was going to happen. So I think a lot of companies kind of tightened up and didn't really want to produce a lot of stuff because they were waiting for the government to kind of let us know what the rules of the game were going to be going forward. First quarter, the rules of the game came out. We kind of got over the fiscal cliff hurdle, and there was this sigh of relief. And that's where we see this 2.5% growth, and that's in the face of the payroll tax holiday expiring, and a lot of people thinking that was going to have a big damper on consumer consumption, which is a huge part of the GDP. Two biggest reasons why we're still able to get 2.5% growth, even in the face of the payroll tax holiday expiring: housing starts and auto sales. Two biggest reasons. These cyclical sectors are doing great. You can see auto sales are back up to their average. They're actually above their average. March, they had 15.6 million units sold. April, we tapered off a little bit. We were just under 15 million, but you can see this trend is very positive. Housing starts. Housing starts for March were 1.036 million, so it's a big jump from 917, best numbers since 2008. So these two areas are really helping us. Private inventories are still really tight. Capital goods orders are still in a good trend here. From 2009, you can see, yeah, we had a little hiccup in 2012, but we're back up to our averages here. So the cyclical sectors still look really good, mostly driven by autos and housing. Consumer finances have improved with low interest rates. A lot of folks have been able to refinance debt, and you can see that by the household debt service. It's at a 30-year. I mean, since they've been tracking this, it's at an all-time low here since at least 1980, at 10.4%. You can see most of consumer liabilities are wrapped up in mortgages. Well, if you have interest rates as low as they are and folks are able to refinance their houses, with house prices coming up, a lot more people have been able to refi at these low rates. That's going to give people more money to go spend or pay off bills, improve their consumer balance sheet, if you want to put it that way. The other thing that's really big is household net worth. We have an all-time high in household net worth. That also makes people feel better, which makes them spend money. The biggest portion of the U.S. GDP, once again, is consumer spending. Corporate finances. So we just talked about consumer finances. We're looking at corporate finances. Corporate finances, very similar story to consumer finances. The companies are bringing in enough cash internally generated to fund capital expenditures. Sooner or later, they're going to start to increase the capital expenditures to try and grow the top line growth and not build up these giant cash reserves that companies have started to build up. Interest coverage ratio at 7.2, you can see that's a giant increase from where we were in 07, 06. Companies are being smarter about their debt levels. Total leverage. Average is 173%. We're at 108%. Now, granted, this is also going to keep us from growing as fast as we were used to, but it's going to also put companies in a better fiscal position. So we see these things as positives, and if credit improves and if consumers start to spend a little bit more money, companies will start to lever up a little bit more, maybe not as much as they were in the early 2000s and late 2000s, but even if they get close, a little bit higher than this 108%, we should see that in the economy. Federal finances are a little different. Yes, we are improving them. They're definitely not as rosy as corporations' finances or as consumers' finances. The budget for 2013 is at $3.6 trillion. Tax revenues that are being collected, that isn't so much the problem. We're back up to 17.8%, which is right in line with our long-term average of 17.9. So that's not a huge problem. The big problem is our spending. And in the Great Recession, we had to increase spending so much that we're just starting to see reductions in the spending, and part of the fiscal cliff talks were that, you know, the payroll tax holiday, that expiring, that brought down some of our spending, and we're slowly getting there, but this number's clearly still too high. So we have to work on that. Just to kind of, you know, recap the fiscal cliff and what I like to call the fiscal cliff step ladder. The gray is what has actually happened, and the orange is the compromise. For the forecast here, the gray would have been, okay, if we would have fell off the entire fiscal cliff, we would have gone from you know, 7% GDP deficit all the way down to a 4% GDP deficit. Instead, we're at about a 5% GDP, just over 5% GDP deficit. So we kind of went in the middle here, and that's why we kind of term this the step ladder. And then next year, we're also going to do a little step ladder, but they're a lot less intrusive, invasive than what could have happened had we fallen off the fiscal cliff. And then to show our federal net debt as a percentage of GDP, if we go down the compromised path in 2022, we should be around 76% with the CBO's estimates. If we would have gone over the fiscal cliff, the estimates show that we would have been at 58.3%. However, a lot of economists said if we would have fallen off the cliff and reduced our deficit by too much, it could have caused a recession, which then would have made this number a moot point, because then we would have had a recession, we would have had to increase spending, it would have been a vicious circle. So that's kind of where we're at there. Jobs, I spoke about jobs a little bit earlier. You know, we've had 200,000 new jobs created per month for the last 6 months. You can see the jobs created during the last 4 years compared to the jobs lost. We still haven't gained back all the jobs that we lost during the recession. Plus, each year, you know, we have roughly 1 million people added to the workforce. So we've got some work to do when it comes to adding, creating new jobs. Unemployment rate, it's at 7.7%. We've seen a great improvement here, but a lot of that is due to the labor force. And what's happened in the labor force is now that markets are back up, people are seeing that, hey, you know, looking at their 401ks, looking at their retirement accounts, they've worked another 4 or 5 years. A lot of folks are saying, I'm ready to retire. So a lot of this improvement in the unemployment has actually been a reduction in the labor force, and that's either people retiring, people being despondent and giving up on the job search. So this 7.7% number isn't really telling us the whole story. If we look at the participation rate for labor force, it kind of tells us that maybe this number should be a little higher. So we do have some work to do with unemployment and with payrolls, with new jobs created. We're really going at a slow pace, and we'd like to see that. We'd like to see those job numbers increasing at a more rapid pace. Inflation, here's a good thing. Inflation is not a concern whatsoever right now. Inflation is actually lower than 2%. The updated numbers are lower than 2%. So the Fed right now is not worried about inflation. In fact, they're more worried about deflation, and in particular wage deflation. So that's why we still have very extraordinarily easy monetary policy, and why they keep coming out and saying that we're going to continue to have very easy monetary policy. Until inflation starts to creep back up, they're going to be very easy for the foreseeable future. Another positive we have is oil prices have actually come down quite a bit. As of 3/31, they were at 97. As of today, they're at 93, which you can see at the end of the quarter, economic drag from oil prices or, from gas has been kind of coming down. And if we updated this chart, it'd even be further down than it is now because oil prices have come down. So that's kind of offset the payroll tax holiday expiration, which has been a good thing. We spoke about the Fed. Want to go a little bit more into detail. The Fed balance sheet has increased to $3.2 trillion over the past 4 or 5 years. This is an unprecedented level for the Fed. It's going to cause some imbalances. Yesterday, the Fed said that they could do more quantitative easing, printing money, if the economy softens, but they also said that they could take some out. So they're really going to be looking at employment growth and GDP growth and inflation to make their determination on what type of quantitative easing they're going to do and how big this balance sheet's going to get. Right now, the reason that inflation is not a problem is because this money multiplier is at 3.6. If this money multiplier starts to increase, then we could start to have a problem. But right now, even though the Fed is printing all this money, it's not going anywhere. It's mostly excess reserves that are kept on banks' balance sheets, and you can see that by this level here. Banks are not loaning this money out yet. When that happens, this money multiplier will go up, and then people will start using the money, and then we can start to see inflation. But until that happens, right now, the Fed is just trying to keep interest rates low by buying treasuries and buying mortgage-backed securities. The Fed's not the only one that's playing by this playbook. Japan, just most recently, came out and said that they were going to have extraordinary monetary easing. The ECB this morning cut rates by 1/4 point. So the global playbook is the same. Everyone is, no one's worried about inflation right now. In fact, they're worried about deflation, and they want to reinflate the economies, and so they're trying to keep interest rates low to ignite economic growth. That's the playbook that most central banks are using. Some of the imbalances that have occurred. Now, I prepared this presentation at the end of March, beginning of April. We were concerned with precious metals. In particular, we were concerned with gold. We still are. However, in between the creation of this presentation and now, gold is no longer at $1,600 an ounce. It got as low as, it actually broke 1,400 a few weeks ago. Currently, it's at 1,470, so it's had a little bit of a recovery. But we lost about 30% from the all-time high that we've seen in gold. And we just bring this sheet up, this slide up, to show that gold is a speculative investment. It doesn't produce anything. The only thing that really changes gold's price, there's pretty much a finite supply of it. It can fit into 4 Olympic-sized swimming pools. The only thing that really changes the price is demand. And so you can see that it's very speculative. In the 70s, it went up 1,200%, and then in the early 80s, it went down 67% from its high, which is an extraordinarily huge drop. Went up 75% again, then down 49%. Most recently, up 609%, and if we updated this number, it's probably down about 25%, let's say. We do not, the way that we see gold is a good insurance play on your portfolio, because usually in times of stress, when all your other asset classes may not be doing well, that's when gold does really well, and we see these spikes. Right now, it's a pretty expensive insurance play. We still think at 1470, it's still a little more on the expensive side. We have a small piece of the portfolio in gold and hard currencies, but we're not increasing our position at these levels. We've had a position most of the way up in the portfolio in some of these hard currencies in gold, and we benefited from gold's exponential increase. In fact, as we rebalance the portfolio, if some of those areas do well, we actually sell from them and buy from areas that haven't done as well. But at 1470, we still think it may be a more expensive insurance play, so we're not adding to our position at this point. Some more imbalances of global easy monetary policy are bond rates. Bond rates did get up to above 2%. 10-year treasuries got above 2% for a little while during the first quarter, and then they dropped most recently when the Fed came out and said some of the things that they said. They may continue, they may do more, quantitative easing, and bond rates, lo and behold, went back down to 1.65%. So we believe that there's a big anchor on these bond rates in the Federal Reserve. And when they start to loosen that anchor, we believe bond rates are going to have to increase, and it could be at a rapid pace. So we want to make sure that we know how that's going to affect our bond portfolios. This slide shows a hypothetical 1% rise or fall in interest rates and how a fall or a rise in interest rates would affect different types of bonds. So if we look at a 10-year treasury here, if interest rates go from where they are now, let's say 1.65%, if they go to 2.65%, your bond, your 10-year treasury, will lose 9% of its value. So you buy a bond for $100,000 and interest rates go from 1.65 to 2.65, you're going to lose about $9,000 on that bond's face value. You can hold it to maturity and get your $100,000 back, but you're going to continue to get only 1.65% the whole entire 10 years, and so you've got some opportunity cost. That's why the bond's price will discount when interest rates go up. Same for these other bonds. You know, something that we have a considerable amount in our bond portfolio is this floating rate. The reason we have a lot of floating rate is because, as you can see, interest rates don't affect it as much. The reason is the interest that you earn on a floating rate is exactly that. It's floating. So every 90 days, usually, these securities change their interest rate. That's why they have a very low interest rate risk, and they don't fluctuate when interest rates rise or fall. Versus investment-grade corporates, where we've got the same kind of thing that we have with treasuries, where, you know, if we have a 1% increase, we lose 7%. So we just want to be aware of that. Now, one thing that is unique for this type of environment that we're in a low-rate environment. We're way over here. Rates are at 1.65% right now. So you can see this is a chart that shows the 10-year Treasury yield and the correlation between interest rates and equity prices. And so you can see there's a higher correlation to, there's a higher positive relationship between yield movements and stock returns when we're below a 5% yield on the 10-year Treasury, like we are now. So we're over here. So, you know, if we were to look at this, we would say, okay, well, as interest rates increase, we should see stock returns also do well. There should be a positive relationship between those two until we start to get to 5%. Once we get to 5%, it becomes a negatively correlated, you know, when interest rates increase, stock prices don't tend to do as well either. So we're in this environment up here. We believe that if we do see the Fed start to exit, although that could be negative for stocks in the short run, when we see interest rates start to increase, that'll get a lot of economic activity going because people will be thinking about, oh, I've got to get a new mortgage, I've got to buy a car, I've got to do these things while interest rates are low, I've got to take advantage of it, I don't want to miss out. Interest rates are starting to go up. You see economic activity pick up, which helps earnings, which helps stock prices. High yield bonds, the risk-return relationship is not as positive as it was a few months ago, where high yield spreads are at very low levels. Leveraged loans spreads are at very low levels in historical perspective. History would say that high yield should have about a 5.9% spread over equivalent treasury, and leveraged loans would need 5.1%. Right now we're much below those. Right now the default rates are much lower. So a lot of the upside is out of high yields. We want to make sure that we're careful with high yield bonds as well. They're going to move more like stocks, but we still want to be careful of what this yield spread is, because at some point we're not going to get paid enough for the risk that we're taking that one of these bonds that we hold could default. Now, recovery rates right now are at much higher levels too. It all makes sense because corporations, have a lot of cash on hand, their interest coverage ratio, all those things that I went over before. Corporations are in a lot better fiscal position. That's why they're not defaulting. That's why when they do default, we're getting 80, almost 90 cents on the dollar. So there's a risk-return relationship between high yield and leveraged loans, and we're starting to see that the upside potential isn't as great as it was. So we want to be careful in these areas too. International, in my opinion, is where there's a good opportunity. So the first slide I started with was a slide that looked very similar to this. We posted that slide August 5th, 2009. Well, as of March 31st, 2013, the developed international index is far away from its 2007 peak. So there's still a lot of opportunity in the developed international markets. If it takes another 3 years to get to their highs, that's still going to be about a 16% return in developed international. That I think anyone would be very pleased to get 16.1% over the next 3 years. So we like international for several reasons, but this is one of the reasons that we like international. Emerging markets, not as undervalued from its peak, but still has not reached its peak and still has a ways to go to reach its peak. So those are areas that we really like, these two areas, emerging markets and developed international. One of the reasons that emerging markets and international haven't done as well is the European debt crisis. Now, over the past 2 years, we've seen interest rates for some of these companies, Greece, Portugal, Spain, Italy, Ireland, skyrocket, and then we came out with the LTRO program, which is the long-term refinancing operation that Mario Draghi came out with, and then more recently, the outright monetary transaction, and Mario Draghi stating that the euro is irreversible. You can see that yields calmed down and have come down ever since those two, LTRO and OMT, which is the outright monetary transaction. Those are good signs. Europe is starting to recover. We're not at elevated levels of bond yields. We like to see those coming down. This is a good trend for a European recovery, which is going to also help some of our international positions. China is the other big one. China's GDP contribution is almost 10%. Their GDP growth is almost 10%, 7.8%. They're a very important piece to the world economy, and a lot of reports are coming out showing that even though growth has slowed in China, we believe that a soft landing is probably in the cards, and not so much a hard landing, especially if Europe is getting better. China does a lot of exporting to Europe, so they need a strong Europe to help them get through their bout with some slower growth as well. Slow growth relative, because they're still at 7.8% growth in GDP. So those are some of the areas that we do see opportunities in internationally. Now, valuations, we've got developed markets. Developed markets are still low, but they're getting back to modest levels. I mean, you can see in the United States, we're getting back to getting close to fairly valued. Now, there are some opportunities, Japan, but they've improved a lot, too, over the past quarter. And so their number has gotten better. But on an overall basis, the EFA index, the Developed International Index, is still below its historic norm, but it's not as attractive as it was maybe 2 or 3 years ago. Emerging markets, on the other hand, are a little bit more attractive, and especially if we look at some of the BRIC nations, minus Brazil. So Russia, China, and India are all below their historic levels when it comes to PE ratios, or when it comes to, I should say, valuation ratios. These are composites of PE, price to book, price to cash flow, dividend yield, kind of all rolled up into one to figure out, okay, on a historical basis, are we cheap or are we expensive? And we still believe that stocks are relatively inexpensive in relation to fixed income. Some alternative investments that may be good yield alternatives, looking at dividends in relation to 10-year governments. So you can see 10-year government yields and some of the yield alternatives. You can have emerging markets, preferreds, U.S. REITs, international REITs. These are all asset classes that we can own that are giving us substantially higher yield than a 10-year government. They do come with some added risks, but you can build a portfolio of other asset classes to get a little bit better yield than just sticking all your money in a 10-year government bond. And it doesn't matter which kind of government bond. You can see that most of the world, we have equity dividends outpacing corresponding 10-year government bond yields. So U.S., our dividend on the U.S. stock market is about 2.2%, and the 10-year Treasury, well, right now is 1.65. So you can see that that's pretty much the case throughout the world. So with a diversified portfolio, we can actually, even if the markets don't go anywhere, we can build a portfolio that generates a decent yield, especially when you compare it to a 10-year Treasury or if you compare it to cash. Speaking of cash, deploying corporate cash. Companies have amassed a huge amount of cash. It appears that stock buybacks have tapered off over the past couple of years, but dividend per share has increased and is at all-time highs. M&A activity is about even, but capital expenditures have increased dramatically. We still have lots of cash on the sidelines. Companies cannot just sit on their cash. You've got companies like Apple sitting on billions of dollars in cash, announcing programs where they're going to give special dividends to shareholders. We're going to start to see these, companies can't just sit on this much cash. They're going to either need to get it working by spending money to help top line growth, giving it back to investors either as a dividend or a share buyback, doing M&A activity. They're going to need to do something with this cash. Otherwise, investors are going to see how much cash they're sitting on and say, hey, you're not being prudent with your business. You're sitting on so much cash. Yes, 2008 has made us realize we need to be more focused on maybe having a bigger cash position, but some of these companies are sitting on ridiculous amounts of cash, and activist investors are going to make them do something productive with that cash. So that'll help. That should help. That should help the stock market when some of this cash is put to work as well. 6-month CDs. Right now, the annual return on $100,000. If you were to buy 2 6-month CDs, your total interest for the year would be $450. Not a great asset class to have right now. It's going to be very difficult to hit retirement goals when inflation is much higher than that. Even though we're in a low inflation rate environment, 0.5% on a money market account is not going to cut it for most people to hit their retirement goals. This chart down here just shows, if we go back to the 02 S&P 500 low, where we had 20% of total household financial assets in cash, we're still at about that level. Yes, we've reduced our cash levels from 09, but we're still in recessionary levels that we were in back in 02. So there's still cash on the sidelines that has not found a home. And as the market continues to get higher, folks are going to look at their portfolios and realize that it's not cutting it, earning 0.45% per year, and they're going to need to get that cash invested, which we believe is going to help mostly stocks. Fund flows. In January, we actually had the highest amount of money in 1 month go into equities at $87 billion. In February, we did not have as good of a month. March a little bit better, but money's still going into bonds, believe it or not, and not so much into stocks. Even though the S&P is at 1,600, we're starting to see it, but there's still a lot of money in bond funds that maybe shouldn't be there, and there's still money in cash that maybe shouldn't be there. So there's a lot of investors out there who are being more conservative than they probably ought to be. And when that money starts to transfer into stocks, when people start getting tired of earning 0.5% in cash or 2% in a 10-year Treasury, 1.65% in a 10-year Treasury, and start to move those to REITs and dividend-paying stocks and preferreds and some of these other things, there could be another step up in the market, which gets us back to a more in line with history level of PE multiple. Another valuation metric that I bring up a lot just when I'm talking about bonds in relation to stocks is the inverse of the PE. So, if we were to look at the S&P as kind of a bond, it's yielding us 7.3% of earnings versus a Moody's Baa yield, which is earning us 4.8%. This big gap here is just telling us that relative to bonds, stocks are a lot more attractive. We can see another big gap back in 2000 when bonds were a lot cheaper than stocks. It would have been great if we would have lightened up our position in stocks back in late 99, early 2000, and bought a whole bunch of bonds that were yielding 8% into a decreasing interest rate environment. That would have been a really good thing to do. I believe being a little bit more overweight in equities than maybe a normal environment would say to be is not a bad thing in this type of an environment. Lagging PE multiples are a little high. We don't like to see this as high as it is. The average is 13.7. During expansions, that's 13.9. We're at 14.4. A lot of this has to do with the current run we just went on. You look backwards, and with such a fast stock run, your lag PE ratios are going to start to increase. At some point, we will have a correction. It will happen. It's just a matter of when. And do we go up another 20% on the S&P before we have a 10% correction, or do we go up another 2% on the S&P before we have a 5 to 10% correction? It's going to be very difficult to time that. What we want to do is we want to make sure that our investors are correctly invested for their particular goal. We're really not trying to time when the next correction is going to happen. If we knew, we'd be out on our yacht somewhere with some computers, and we wouldn't need to really work. We'd just manage our own money, and we'd know exactly when to get in and when to get out of the stock market. Life would be good, but that's a dream. That does not happen. We cannot time the market, so we need to start with a diversified, tried and tested portfolio. PE ratios, so this is talking about forward-looking PE ratios versus the lag. This was lag PE ratios. This is forward-looking PE ratios. Forward PE ratios, this is lag PE ratios as well at 14.4. You can see that the implied return in a normal environment, if we had a 14.4 PE multiple, we'd be looking at an implied return of 11.9% per year for the S&P 500. Now, this slide really is not trying to tell us that PE has everything to do with returns. It's saying on a year-to-year basis, given that the PE ratio is 14.4, I couldn't tell you what the stock market's going to do. These blots are all over the place. But that's over a one-year period. If we extend this to a 5-year period, we have a much cleaner regression line, and you can start to expect, okay, we're at 14.4. The next 5 years, we're most likely, if history repeats itself, we're going to have a positive return, most likely. And most likely a decent positive return. Now, we're also in an environment when inflation's at 2%, so that's going to be a little bit trickier. But for a lot of when inflation's lower, our clients don't need to earn as much because they don't need to have their expenses inflation adjusted or by as much. So it's really the real return that we care about. And in a lower inflation environment, we're going to probably get lower stock returns, but that's okay because it's the real return, the difference between the nominal return or what everyone sees on their statement. I earn 7%. You subtract that, you subtract inflation from that. So if you earn 7%, you subtract 2% for inflation right now, your real return was 5%. If inflation is 5%, and we earn 7%, our real return is only 2%. So as inflation increases, our stock returns should increase. It's that real return that should be really what we're targeting. I always have this slide in here because it shows the importance of not letting emotions dictate stock decisions and allocation decisions. You can see that most of these asset allocations, bonds, international, oil, S&P, even gold, REITs over the last 20 years have been significantly higher than what the average investor gets. And the reason the average investor only gets 2.3% is because they're jumping in and jumping out of the stock market at the wrong times. If we go back to, it all starts with the wrong portfolio for the wrong goal. If somebody's in an all-stock portfolio and they need money in the next 2 years, Well, when the market drops 20% and then another 20% and you needed the money, you're going to be forced to sell at the wrong time. So it starts with the correct time frame, and then you don't want to be diversified as well, so you're not having to sell at the inopportune time, and so you have pieces of your portfolio that no matter what environment we're in are going to do okay, and you can go to those areas first and give your other assets time to get back to where they should be over a long period of time. So we want to make sure that we have the correct time frame and that we're not forced to make emotionally driven decisions. Because we don't want to earn 2.3% when if we just bought the S&P and held it, we would have earned 8.2. That's not what we're trying to do. We're trying to get, somewhere between all of these asset classes, not this 2.3% in this type of an environment. The other reason I like to put this slide in here, we've got a very simply diversified portfolio, 55% in stocks, S&P, 30% in bonds, and 15% international. The return on that would have been 7.43%, and the risk or standard deviation would have been 10.8. If we add some other asset classes, commodities, market neutral, real estate, small cap, emerging markets, if we add those, we actually decrease our risk and we increase our return. That is the entire reason why we like to have a diversified portfolio. Each of these asset classes have different correlations to each other. So you can smooth the ride of your portfolio and still eke out a higher return. That's ultimately what you want to get from your portfolio, a smaller risk and a higher return. And then this last slide here, I believe this is the last slide, is all about time frames. There's never been a time frame in the last 62 years where a 50-50 portfolio has lost money over a 5-year time frame. So if somebody has something to buy or some expense that they have in 1 year, they should not have it in equities. They should probably not have it in bonds. They should probably not have it in a 50-50 portfolio if it's a 1-year time horizon. If it's a 5-year time horizon, now we can start to utilize some equities, some bonds, maybe a mixed portfolio. If we have 20 years before we need to use this money, well, now we really want to have this money work for us. We want mostly equities if we can stand the volatility of the portfolio. So this is just showing, if we got 10.8% on 100,000 over 20 years, we'd finish with 782,000. We had bonds at 6.2%. That's a big difference there, 335. 50-50 portfolio earns 8.9%, and we're left with 554,000, and the different volatilities with the different time frames. So these are very important issues that we want to make sure everyone's aware of, and that we have the correct time frame, the correct portfolio for each person's individualized goals and objectives. Investment implications, this is the last, well, no, there's one more slide after this, excuse me. Overweight, commodities, they have done very poorly. That's a place where if the Fed starts to tighten rates or tighten monetary policy, inflation could creep in and commodities could do well. So we like commodities. Floating rate bonds, like I spoke about earlier, they have less interest rate risk. Market neutral, it's another place where it doesn't have a ton of volatility, but we can get a little bit better return that's not very interest rate sensitive. So we can take some of our bond exposure and put it into market neutral. Emerging market equities and international, we already spoke about that. Underweight, fixed income, especially long duration. We do believe interest rates will be increasing probably faster than most people think. We do not want to be in long duration fixed income, treasuries. Now, all of these things we have exposure to, we're just underweight. We don't want to abandon any asset classes. We don't know what's going to happen tomorrow, but we do want to put our slant on them, and these are the things that we're underweight. Precious metals, we still believe gold is overvalued, although we were pleased to see the move that happened during April. That put it back into a little bit better, more reasonable price. And then REITs. REITs have done very well for us. We've been overweight REITs for a while. REITs have done very well because there's a lot of people flocking to things that give them extra yield. So there's been kind of a run up there. We want to kind of take some of our profits. We still have exposure to REITs, but we have less than we did, say, 6 months ago. So those are the investment implications in this environment. As you can see, sticking to my long-term diversified portfolio talk here, each asset class, it can either be on the top or the bottom. You know, emerging markets, top, second best, top, worst, top, middle, worst. We got another worst, top. So, I mean, if you can handle down 53%, up 79%, then maybe 100% emerging markets portfolio might be right for you. Most people can't, and there's a way to actually decrease the risk of any one asset class. That's this asset allocation, and this is just a simple asset allocation. It gives you a good idea, though, and you can see the last 10 years. An asset allocation portfolio that consisted of 25% in the S&P, 10% in small cap, 15% international, 5% emerging markets, 25% bonds, 5% treasuries, 5% market neutral, 5% commodities, and 5% REITs, would have increased 117% over the last 10 years, which equates to about 8.1% per year. That's a pretty good rate of return. That's going to hit a lot of investors' goals if we can get that type of nominal return. So I'll end with that. And at this time, you can go ahead and look in your browser. There should be a box where you can direct your questions, and we're going to have Steve run the question and answer section here.
All right, thank you, Sean. Looks like we already have a few questions that have come in, so we've got a couple about gold. So first off, we have one question that says, no way, all the gold in the world into 4 Olympic swimming pools?
Believe it or not, that is correct. All the world's gold can fill 4 Olympic-sized swimming pools.
Okay, we've got, you consider gold to be an overvalued insurance-like investment, but where do you see it performing in the long term?
So I'm going to go back to this gold slide. Let's see here. Short answer is with inflation, but I want to show you why. Current slide. Okay, here we go. So here's gold's performance. You can see that since the 70s, there's been 2 spikes. Other than the 2 spikes, it's basically gold has kept up with inflation. It is a store of value. By definition, it's going to go up with inflation, and that's what we expect it to do long run. That's why we look at it as an insurance policy against the portfolio. Long term, it's not. We don't believe it's going to be something that it doesn't produce anything, so it's only worth what somebody else will pay for it. Therefore, we want to have it in the portfolio so that if if there's a political crisis and stocks do very bad and gold does really well, that we can sell some of our gold and buy some of our stocks. It's a good insurance play for the portfolio so that we have some downside protection in case bad things happen in the world or in the U.S. Where gold is going to benefit from that. And then we're able to use that, reposition into aggressive assets that haven't done as well.
Okay, so it's an effective hedge. We have another question that says, I know that it's earnings season. Is there anything in particular we should be on the lookout for?
Anything particular? Not necessarily. Most companies are beating, although estimates are growth in earnings isn't all that great right now. We're talking about low single digits. But the PE ratios being at 13 or 14 still doesn't, that doesn't equate to low earnings growth equaling bad stock market performance. One of the things that we have noticed is that a lot of companies have pared down expenses, i.e. human capital, and that's why they haven't hired back the workers that they've gotten rid of. Many companies have become way more profitable and way more efficient. They're probably not going to be hiring those workers that they got rid of in the recession because they figured out a way to become more profitable with less resources. At some point, they're going to have to increase the revenue numbers, and they're going to have to try and do some things that are innovative, that are going to require them to hire, to invest capital, to expand, to expand their top-line numbers.
We have another question that says, you mentioned earlier that the S&P pays a dividend of about 2%. Do international companies pay a similar yield?
They do. They pay actually a higher yield. Right now, the EFA is paying about 3.5%. Trying to figure out if I have a slide in here that shows that. I don't think I do. Both international and emerging markets are paying around 3.5%. And that's another benefit. Not only are they undervalued in our estimation, but they're also paying us a higher dividend. That's another reason why we find them to be more attractive in the current environment than domestic stocks at this exact time.
Okay. Looks like we have one more. And it says, seeing you've spoken a lot about PE ratios, but what exactly does the PE ratio tell us about a stock's value?
So PE ratios is, so you always hear me talk about PE ratios. PE ratios, maybe I should explain them a little bit better instead of just throwing them out. A PE ratio is the price of the stock to the earnings that the company has earned. And so if you have a PE ratio of, let's say, 15, in essence, somebody is willing to pay today 15 years forward of earnings. So 15 times today's earnings. So that's why it's very important when valuing companies to figure out, okay, well, what's the earnings stream of that company, and when will I be paid back? If the earnings continue to grow at, let's say, 5%, how long will it take me to get my money back that I put into this company? Well, earnings are what drive stock prices. So if earnings increase, well, the stock price is going to increase, everything else staying constant, and fear not being in the market, greed not being in the market. If somebody's willing to pay 15 times earnings today, and a year from now earnings are 10% higher, if they're still willing to pay 15 times those earnings, your stock price should be up. And so that's why I spend so much time with earnings price to earnings multiples is that the earnings is what the cash flow to the investor or to the investors is. And that's one way to value a company. There are several ways to value companies. That's just one of the ways that is more common.
Okay, looks like that's all the questions we have.
All right, I'd like to thank everybody again for joining us tonight. And we will see you next quarter. Take care.